Three numbers. That's all it takes to control your entire life. Where you live, what you drive, whether a bank will even talk to you. And nobody questions it anymore because we've been conditioned to think this is normal. Like it's always been this way. It hasn't. 35 years ago, this system didn't exist. Two guys in California invented it, sold it to every bank in America. And now you're stuck playing a game where the rules change based on whether you're profitable enough. Miss one payment? You're punished. Pay everything off? Congratulations, you're boring. They don't make money off boring. Buy nothing and stay out of debt completely? Well, then you don't exist. No score means no apartment, no car, no mortgage. You're a ghost. Think about that for a second. The only way to prove you're financially responsible is to borrow money you don't need and pay interest you could have avoided. That's not a system designed to help you. That's a trap. And it gets so much worse. 1989, Bill Fair and Earl Isaac are sitting in an office trying to solve a problem banks have. Lending money is slow. Every application needs a human to review it. Interview the person. Check references. Make a judgment call. It's expensive and subjective. So Fair and Isaac built an algorithm. Feed it someone's payment history, debt levels, credit age, and it spits out a number. 300 to 850. Banks loved it immediately. No more loan officers. No more conversations. Just run the number and approve or deny. Efficient, right? Scaled beautifully. By 1991, Equifax, TransUnion, Experian, all three credit bureaus adopted it. Your entire financial existence reduced to a formula you'll never see. Proprietary. Secret. You can't audit it. Can't challenge the math. Just have to accept whatever number it assigns you. And everybody acted like this was progress. Finally, an objective system. No discrimination. Just pure data. Except it's not measuring what you think it's measuring. 35% of your score is payment history. Makes sense. 30% is how much you owe. Also reasonable. 15% is length of credit history. Okay. 10% is types of credit. 10% is new inquiries. Seems fair on the surface. But watch what happens when you actually use the system. Pay off your credit card every month. Score barely moves. Carry a balance and pay minimum plus interest. Score goes up. They're not rewarding financial responsibility. They're rewarding profitable behavior for banks. You're being scored on how much money they can extract from you over time. And the consequences compound in ways that are genuinely insane. Bad credit means higher interest rates. So you pay more for the same loan, which makes saving harder, which means you borrow more, which hurts your credit further. It's a feedback loop baked into the algorithm. But here's the part that should make you furious. You can't opt out. Try living without credit. Pay cash for everything. Build savings instead of taking loans. Know what happens? Nothing. No credit file. And banks treat no credit history as high risk. So when you finally need a loan, maybe for a house, you're penalized worse than someone who's been carrying credit card debt for a decade. The system punishes independence, forces participation, and once you're in, the math ensures you stay in. But a credit score by itself isn't enough to trap people permanently. It's infrastructure, the foundation. To really lock someone in, you need debt they can't discharge no matter what happens. And they found the perfect product. Student loans. Look, the Higher Education Act in 1965 had good intentions. Let every kid afford college regardless of family wealth. Government guarantees the loans. Banks lend the money. Students invest in their future. It actually worked at first. College enrollment exploded. Kids from working-class families became doctors, engineers, teachers. The American dream playing out exactly as designed. But then something shifted. Colleges realized students had access to guaranteed loan money. So they raised tuition. Why wouldn't they? The students could just borrow more. Government would back it. Banks made interest. Colleges made revenue. Only people taking real risk were 18-year-olds signing documents they barely understood. By the 1990s, it's spiraling. Tuition increasing faster than inflation, faster than wages, faster than healthcare costs. And Congress kept raising loan limits to match. More borrowing capacity led to higher tuition, which led to higher loan limits, which led to higher tuition. Perfect circle. Then 1998. Congress did something that still blows my mind. They made student loans non-dischargeable in bankruptcy. Let that sink in. You can declare bankruptcy on credit card debt from gambling losses, on medical bills from cancer treatment, on business loans from a failed startup. But student loans? They follow you until you pay them or you're gone. The justification was that students were supposedly graduating and immediately declaring bankruptcy to dodge repayment. The data showed this was practically non-existent. Didn't matter. Banks wanted protection. Congress gave it to them. 2005, they extended it to private student loans too. Now, even predatory lenders got the same protection. The debt became inescapable by law. And we're living with the consequences right now. Americans owe $1.6 trillion in student debt. 1 in 6 borrowers is in default. Nearly 40% aren't even paying down principal, just covering interest or not paying at all. And the interest keeps compounding regardless. Here's a real scenario. Teacher borrows $70 grand for undergrad and grad school combined. Starts making $52,000 a year. Monthly payment comes out to $308. Sounds manageable, except interest accrues at $325 per month. The balance grows even while making payments. For 8 years, the debt increases. This isn't a bug in the system. This is the system working exactly as designed. Income-driven repayment plans sound like a solution. Pay based on what you earn instead of what you owe. But they extend the term to 25 years. And during that time, unpaid interest capitalizes. The balance balloons. Many borrowers will make payments for decades and still owe more than they originally borrowed. Meanwhile, the government profits about $50 billion per year from student loan interest. Banks profit from servicing fees. Colleges profit from inflated tuition. The students? They're the only ones losing. Told that education was the path to success. And technically it still is. But now that path costs a quarter-century of payments. And for a lot of people, the math never works out. They'll never escape. But credit scores and student loans still require deliberate decisions. You apply for the loan. Sign paperwork. There's friction, psychological resistance to borrowing. So they needed something smoother. Something that eliminates the mental barrier completely. Enter buy now, pay later. And this thing is spreading faster than anything I've seen. Affirm, Klarna, Afterpay, all these companies exploded during the pandemic. The pitch is dead simple. Split your purchase into 4 payments. No interest. No fees if you pay on time. Just convenience. Sounds harmless. Actually sounds helpful. Except the data tells a very different story. 63% of buy now, pay later users have multiple loans running at the same time. From different companies. Stacking payments across platforms. And these users carry an average of $871 more in credit card debt than people who don't use buy now, pay later. Plus $453 more in personal loans. They're not avoiding debt. They're accumulating it faster. Because the psychological friction disappeared. Buying a $1,500 laptop feels impossible when you're looking at your bank account. But 4 payments of $375? That's manageable. Your brain processes it completely differently, even though the total cost is identical. The friction is gone, and so is your ability to gauge whether you can actually afford it. Now here's the trap within the trap. Buy now, pay later loans aren't reported to credit bureaus. They're invisible, not tracked anywhere official. So you could have $5,000 in buy now, pay later obligations, making every payment on time. Perfect history. And your credit report shows exactly none of it. When you apply for a mortgage or car loan, the lender sees your credit score and thinks you're financially stable. They have no idea about the hidden debt bleeding you every 2 weeks. The system is deliberately fragmented to hide the real burden. And the consequences are starting to show up. Buy now, pay later delinquencies rising. Late fees piling up. But because it's not reported, it doesn't appear in economic data. Economists can't measure it. Policymakers can't see it. Consumers are drowning in it. Invisible until it destroys you. Now watch how these 3 systems lock together. You're 22. Graduate with $50,000 in student debt. Need an apartment. The student loans hurt your credit score. Landlord wants first, last, and deposit. You don't have it. So you use buy now, pay later to spread the cost. Now you're juggling student loan payments, rent, and hidden installment debt. Your credit utilization goes up because you're using available credit. Score drops. 6 months later, you need a car to get to work. The interest rate comes back at 12% instead of 4% because your score is mediocre. Higher payment means less money for everything else. Student loans go on income-driven repayment, which extends the term and balloons the interest. Fast forward 5 years. You're still paying student loans. Credit cards are close to maxed. Buy now, pay later payments hitting every 2 weeks. And your credit score is stuck because you're using too much credit. But you can't pay it down because your income barely covers minimums plus rent plus student loans. No room for error. No room to save. Any emergency pushes you deeper. Let me show you the actual math. Say you make $60,000 per year. After taxes, about $4,000 per month take home. Rent in a medium-cost city averages $1,800. Student loan payment is $400. Car payment $350. Insurance $150. That's $2,700 already gone, leaving $1,300 for food, utilities, phone, gas, healthcare, everything else. There's no margin. Any unexpected expense, and you're using a credit card, which increases utilization, which drops your score, which increases interest rates on everything, which makes monthly payments higher, which leaves even less room. The math doesn't work. It's not supposed to work. Because if you could pay off the debt, the system stops making money. 70 million Americans have medical debt in collections. 45 million have student loans. 190 million carry credit card debt. Buy now, pay later users projected to hit 100 million next year. These aren't coincidences. Every piece was engineered with full knowledge of what it would do. Bill Fair and Earl Isaac knew their credit score would reward debt-carrying behavior. The formula was designed that way intentionally. Congress knew making student loans permanent would trap borrowers. The banks lobbying for it explained explicitly why they wanted the protection. Buy now, pay later companies know their product creates phantom debt. Their internal data shows users stacking obligations across platforms. None of this is accidental. Every mechanism built with complete awareness of the outcome. And the justifications are always the same. Credit scores eliminate bias. Student loans increase access to education. Buy now, pay later provides flexibility. All technically true, but the cost is permanent indebtedness for most users. And the profit flows one direction. Up. Credit bureaus charging for scores. Government earning $50 billion yearly on student loans. Banks collecting interest forever. Buy now, pay later companies taking merchant fees on every transaction. The system works exactly as designed. Not to build your wealth. To keep you paying perpetually. And they're not done. Next evolution is already being built. Central bank digital currencies. Programmable money where every transaction is tracked. Every purchase monitored. And your ability to spend could be limited based on social credit, carbon footprint, political views. The infrastructure is being built right now. Once it's in place, the debt trap won't just be financial. It'll be total. Your access to money itself controlled by the same institutions that design credit scores, student loan systems, buy now, pay later schemes. This isn't speculation. It's trajectory. Every system they've built concentrates control and extracts wealth. Each new version makes escape harder. So what do you actually do? First, understand you're playing a rigged game. Your credit score isn't measuring financial health. It's measuring profitability to banks. Optimize accordingly. Keep old cards open even in used. Maintain low balances, but don't close accounts. Use credit strategically, but minimize interest payments. You're gaming a system that's gaming you. Second, avoid student debt if remotely possible. Community college, trade schools, apprenticeships, any path that doesn't require massive borrowing. If you already have student debt, understand the repayment options. Income-driven plans might be least bad, even though they extend the term. Third, treat buy now, pay later like the debt it actually is. Every payment is a monthly obligation. Track all of them. Don't stack multiple loans. Never use it for essentials. If you can't afford groceries without splitting payments, you're in crisis and need a complete budget reset, not more debt. Most importantly, recognize that building actual wealth requires escaping the system entirely. Own assets that appreciate, not liabilities that drain you. Save before you spend. Build emergency funds so you're never forced to borrow. Understand that every dollar you pay servicing debt is wealth you're transferring to someone else. The system is designed to keep you paying forever. The only real way out is refusing to play their game. Buy less. Borrow never. Save aggressively. Build assets. It's harder than clicking buy now, pay later. But it's the only path to actual financial freedom. Everything else is a trap. And they designed it that way deliberately. If this changed how you see the financial system, if you finally understand that your credit score, student loans, every easy payment plan, all of it engineered to keep you trapped, then subscribe. Because nobody else is teaching you this. They're teaching you to borrow responsibly, build credit, finance your dreams. None of that makes you wealthy. It makes you profitable to them. Comment if this opened your eyes. Share it with someone drowning in payments who thinks it's their fault. Because once you see the trap, you can't unsee it. And the first step to escaping is realizing they built it on purpose. Every piece, every mechanism, every rule. They designed a system you can never escape. Unless you stop playing.